Ladies and gentlemen, Asian guy here. COMEX silver closed at $75. Shanghai physical traded at $89 the same day. That $14 gap is not a premium. It is a confession. Stop looking at the cheerleading. Stop looking at the hype. This is about math and what happens when arbitrage dies. I'm going to show you the three mechanisms that killed the paper market. The hard data proving physical extinction and what this means for your position right now. The body has been found. Arbitrage is the glue holding global markets together. When it breaks, price discovery fails, and one market becomes irrelevant. On December 24th, 2025, Shanghai physical silver closed near 89 per ounce, while COMEX futures hovered at $75. This is not a premium. It is backwardation at a structural level. Do the math with me right now. Historically, arbitrage traders would buy COMEX paper, take delivery, and sell into Shanghai for instant profit. At a $14 spread, that's an 18.6% gain per transaction. No one is doing it. Why? Because the arbitrage is broken. Three killers destroyed it. Export controls. China has quietly tightened licensing, choking the flow of metal out of Western vaults into Eastern hands. Delivery constraints. COMEX registered inventories are bleeding. You cannot arbitrage what you cannot deliver. Paper distortion. Futures pricing is divorced from physical reality because the paper market is over-leveraged and cannot honor delivery at scale. Now I need you to understand what this means. Compare this to 2020 pandemic premiums. Those were 2.24% over spot. In 2011, during the squeeze, premiums hit 5-8%. We are now at 18% plus. This is not a temporary dislocation. It is a market in failure mode. Let me give you context. In 2008, gold saw a similar but smaller spread between London and New York. It corrected in weeks because arbitrage still functioned. This silver spread has persisted for weeks and is widening. The crime scene is active. The Shanghai premium is not noise. It is the market screaming that physical metal is worth $89, not $75. COMEX is pricing paper promises. Shanghai is pricing real ounces. When those two prices diverge by nearly 20%, the paper market has lost credibility. But here's where it gets worse. The spread is not closing. Normally, when a gap like this opens, capital floods in to exploit it. Traders buy the cheap asset, sell the expensive one, and pocket the difference. That mechanism, arbitrage, is what keeps global markets synchronized. It is the invisible hand that prevents price distortions from persisting. That hand is broken. Why? Because the metal is not moving. Export controls mean you cannot get the silver out of COMEX and into Shanghai fast enough to close the trade. Delivery constraints mean even if you could export it, COMEX does not have enough registered inventory to honor the contracts. And paper distortion means the futures market is so overleveraged that taking physical delivery at scale would trigger a default event. The arbitrage traders know this. They are not touching it. The $14 spread is not an opportunity. It is a warning. It is the market telling you that one of these prices is a lie. And the lie is always on the paper side. Connect the dots. When arbitrage dies, the market with the real asset wins. The market with the paper contracts becomes irrelevant. COMEX is pricing a fantasy. Shanghai is pricing reality. The $14 spread is the distance between those two worlds. This brings us to the smoking gun. What is actually happening inside the COMEX vaults? Registered silver is the only metal available for delivery against futures contracts. When it shrinks, the paper market loses credibility. COMEX registered silver inventories have been in freefall. Major drawdowns reported through late 2025 show vaults losing eligible and registered ounces at an accelerating rate. This is not rotation. This is depletion. The smoking gun is this. When registered inventory falls while open interest stays elevated or rises, you have a structural mismatch. The market is writing checks it cannot cash. Now connect the dots on the delivery constraint feedback loop. Physical buyers in Shanghai demand real metal, not paper promises. COMEX struggles to source registered inventory to meet delivery requests. Premiums spike in physical markets as buyers pay more to secure real ounces. Arbitrage traders cannot close the gap because export controls and vault constraints block the flow. This is backwardation on a global scale. Backwardation means near-term contracts trade at a premium to future contracts. It is the market screaming, I want the metal now, not later. Shanghai's sustained premium over COMEX futures is exactly that signal. The physical market is paying more because it cannot wait. The paper market is pricing in the assumption that supply will magically appear later. It will not. The margin squeeze confirms the stress. Brokers have raised margin requirements on silver futures contracts in response to volatility and delivery strain. Higher margins mean fewer speculators, less liquidity, and more price distortion. When margin requirements spike, it is a red flag that the exchange is terrified of a delivery failure. Lease rates are spiking. When bullion banks charge higher rates to lend physical silver, it signals shortage. Recent reports show lease rates climbing as physical tightness intensifies. Banks are not lending metal because they do not have enough to lend. They are hoarding it. Do the math on registered versus open interest. If COMEX has 50 million ounces registered and 200 million ounces in open interest contracts, representing future delivery, only 25% of contracts can be honored with physical delivery. The rest are forced into cash, settlement, or rollover. That is paper genocide. The contracts are worthless because they cannot be converted into metal. Let me give you context. In 2021, the Reddit silver squeeze briefly drained some COMEX inventory, but arbitrage and new supply refilled the vaults within months. This time, the vaults are not refilling. China is not exporting. The registered silver is gone, and it is not coming back. The delivery data tells the story. When delivery notices spike, but registered inventory keeps falling, it means the remaining metal is being pulled out faster than it is being replenished. This is not a squeeze. This is a structural shortage. The paper market is running on fumes. COMEX is bleeding registered inventory and cannot honor delivery at scale. Meanwhile, Shanghai is hoarding every ounce it can get. Let me show you China's endgame. China controls the narrative now because China is the world's largest silver producer and a dominant industrial consumer. Solar panels, EVs, electronics. When they restrict exports and hoard physical, they set the global price floor. Shanghai's physical silver trading in the $78.89 range is not speculation. It is the real clearing price for physical metal in the world's largest manufacturing economy. The export control weapon is already deployed. China has tightened licensing and export quotas on silver. This is not a temporary policy. It is a strategic move to ensure domestic supply for industrial and monetary purposes. They are not letting the metal leave. Now, I want you to look at the industrial demand surge. China's solar panel production alone consumes roughly 20% of global silver supply. EV production, 5G infrastructure, and electronics add millions more ounces. This demand is structural and non-negotiable. China cannot build its industrial future without silver. They know it. That is why they are locking down supply. Here is how China is weaponizing physical scarcity. By restricting exports, they force Western buyers to compete for shrinking supply at higher prices. By maintaining a 14+6 premium over COMEX, they signal that paper pricing is irrelevant. By hoarding physical in Shanghai vaults, they create a price anchor that Western exchanges cannot suppress. The VAT and premium structure matters, but even accounting for those, roughly 6 to 8%, the premium over COMEX is still 10% plus. This is not tax. This is scarcity pricing. This is China saying we control the physical, pay our price or go without. The geopolitical angle is undeniable. China's silver strategy mirrors its earlier moves in rare earths and lithium. Secure domestic supply, restrict exports, dominate pricing. Silver is now a strategic resource, not just a commodity. It is a national security asset. The BRICS factor amplifies this. As BRICS nations explore gold-backed trade settlements, silver's role as an industrial and monetary metal becomes even more critical. China is positioning itself as the gatekeeper. They are building a system where the physical metal flows through them, not through London or New York. The message to the West is clear. The $89 Shanghai price is a statement. We control the physical. Your paper contracts are worthless. Pay our price or go without. Let me give you context. In 2010, China restricted rare earth exports, and prices spiked 10x within months. The West scrambled to find alternative sources, but never regained pricing control. Silver is following the same playbook, but this time, the West has no alternative source at scale. There is no backup. China has the mines, the refining capacity, and the industrial demand. They have checkmated the West. China has the physical, the industrial demand, and the export controls. COMEX has paper contracts and empty vaults. This is not a fight. It is a fait accompli. Now let me tell you what this means for you. This is not a correction. It is a phase change. When arbitrage breaks and physical decouples from paper, the paper market becomes irrelevant. Pricing authority shifts to the physical market permanently. What does extinction look like? COMEX futures will continue to trade, but they will price at a persistent widening discount to physical. Cash settlement will replace delivery. The futures market becomes a side bet, not a price discovery mechanism. It becomes irrelevant. The repricing event is coming. If physical scarcity tightens further and Shanghai premiums widen to $20, $30 over COMEX, the paper market will face a credibility crisis. Institutional buyers will abandon futures and demand physical, accelerating the collapse. When the big money moves, it moves fast. Now, I need you to understand the forced cash settlement scenario. When COMEX cannot deliver physical against contracts, it will force cash settlement at the paper price. Buyers expecting $89 physical will receive $75 cash. This is legal under futures rules, but it is also the death of the contract's legitimacy. Once that happens, no one will trust COMEX pricing again. Here's how this affects your position. If you hold paper silver, ETFs, futures, unallocated accounts, you're exposed to the COMEX price, not the Shanghai price. You are holding the losing side of a broken arbitrage. Your paper contract says $75. The real metal is trading at $80. That gap is your loss. If you hold physical silver, you are positioned in the market with pricing power. Your metal is worth what Shanghai says it is worth, not what COMEX pretends. You're on the winning side of the divergence. The inventory monitoring strategy is simple. Watch COMEX registered inventories, Shanghai premiums, and lease rates. When registered silver falls below 40 million ounces and Shanghai premiums exceed $20, the repricing event is imminent. These are your early warning signals. The backwardation signal is critical. Sustained backwardation in COMEX futures, near-term contracts trading above long-term, is a red flag that delivery stress is critical. This is your early warning system. When the front month trades at a premium to the back months, it means the market is panicking for immediate delivery. The actionable step is this: diversify into physical silver and treat paper contracts as high-risk speculation. Physical is the only position that benefits from the extinction of the paper market. Paper contracts are a bet that the system holds together. That bet is losing. The contrarian truth: mainstream media will call this a temporary dislocation or regional premium. Do not let them gaslight you. A 14-lane spread that persists for weeks is not noise. It is the market screaming that the paper system is broken. The divergence is the signal. The divergence is the truth. The final math: if you believe physical scarcity is real and China's export controls are permanent, then the COMEX price is irrelevant. The only price that matters is the price at which you can actually buy physical metal. That price is $89 and rising. Everything else is a lie. This is not a prediction. It is a pattern already in motion. The arbitrage is dead. The vaults are empty. China owns the physical. The paper market is in its extinction phase. The 14 spread between COMEX and Shanghai is not a premium. It is proof that the paper market has lost pricing authority. Physical scarcity is real, and China controls the supply. If you are holding paper silver, understand the risk. If you are holding physical, you are positioned in the only market that matters. Subscribe for the data that Wall Street does not want you to see.